Hey everyone, are you thinking about buying a home? Worried a little bit about that down payment amount? Have you ever heard of mortgage insurance? No? Well, today we're going to break all of that down, and that is why you might need this video. You might need that mortgage insurance, you might have to pay for that mortgage insurance, and how you can get rid of that mortgage insurance. So let's jump right in. Hi everyone, I'm Katie Evans, owner and lead agent of the Living 48 Real Estate Team, and welcome back to another one of our weekly vlogs. First things first, let's discuss mortgage insurance. What the heck is mortgage insurance? Well, simply put, it's simply a policy, an insurance policy, that protects the lender in case you stop making your payments um, on your mortgage. And wait, why do you have to pay it if it protects them? Well, because it allows the lender to have a little bit more risk because you have a little bit more skin in the game. So you can actually qualify for a home loan with a smaller down payment. That is what mortgage insurance allows you to do, private mortgage insurance. So while it is an extra cost, it actually helps more people get into a house sooner. That is what it is. Now, there are two main kinds of mortgage insurance, and which one you pay depends on what your loan type is. So the first one is PMI, or private mortgage insurance. You've probably heard about that one. That one is for conventional loans when you put down less than 20%. Yes, you heard me, less than 20% on a conventional loan. There are those loans out there, and with that, you are going to be required to pay PMI, or private mortgage insurance. Your lender arranges it, you pay it as a part of your monthly premium, and the good news is once you hit 20% equity in that house, you can have that PMI insurance removed from your policy. Now, the second kind of mortgage insurance is called MIP, or mortgage insurance premium. This one is for FHA loans. And here's the kicker. You're going to pay that no matter how much you put down. Yep. It's an upfront fee at closing and a monthly premium, and it sticks around for the life of the loan. You could refinance it off into a conventional, that kind of stuff, but it's there for the life of the loan. And that one is on an FHA government-backed loan. Okay, so who is it that actually needs mortgage insurance? Who gets stuck with it? Well, if you're putting less than 20% down on a conventional loan, or you're just flat out getting an FHA loan, congratulations, you're it. You're the one who gets to pay it. You qualify, you have to have it. So what about VA and USDA loans? Well, they don't actually have mortgage insurance, but, big fat but, all in capitals, they do have other fees. Like they have a funding fee, they have a guarantee fee, and they sort of kind of act the same way as mortgage insurance. So let's talk about what you're actually going to pay. All right. Mortgage insurance isn't a one size all kind of thing. It depends on, number one, your loan type. We already talked about that, if it's PMI versus MIP. It depends on your down payment amount. The smaller your down payment, the higher your insurance cost is going to be. Number three, your credit score. Higher your credit score, lower your mortgage insurance. And number four, your loan amount. The bigger the loan, higher the premiums. PMI is typically going to run you between 0.3% and 1.5% per your loan per year. That's going to be divided into monthly payments. And then your MIP, again, you're going to pay that as like an upfront. Typically, it's around 1.75%. Plus, there's going to be that annual premium from around 0.45% to like just over 1%. So, how do you get rid of mortgage insurance? And the good news is you can get rid of mortgage insurance. So, again, PMI, it doesn't last forever. Once you reach, on a conventional loan, 20% of equity in your property, then you can ask your lender to remove that. Sounds great. And if you forget, don't worry. After a while, they automatically have to drop it once you're at 78% of your home's original value. I wouldn't want to wait that long, but if you're not keeping track, there is good news. It will automatically fall off at some point. MIP, on the other hand, well, that one is a little bit trickier. Again, that lasts for the life of that loan. So if you put down less than 10% on an FHA loan, MIP stays for the life of the loan, start to end, okay? But if you put 10% down or more, it drops off after 11 years. Or, and this is probably the route you'll end up going, you can refinance that loan into a conventional loan. And then once you have enough equity, obviously, bye-bye. You're going to lose your PMI, you're going to lose your MIP, all of the above. So, bye. That's the great news. So, what is mortgage insurance? Yeah, it's insurance. It protects the lender. It's not great, but it's there, and that's what it is. And it does make homeownership possible for more people earlier. You don't need to have that 20% down to buy a house. And the faster you build equity in your house, the quicker you can ditch that mortgage insurance. So if this helped, please do us a solid, hit the like, hit the subscribe, maybe put a little bit of a comment in there so help us get out there. If you know someone who needs this information, share it with them. And as always, if you are interested in our assistance or if we can be of any assistance to you at all, there are no dumb questions. Reach out to us. We would love to help you with any of your real estate questions or needs. We specifically work in Arizona real estate market. However, we have connections across the country and beyond. So please don't hesitate to reach out to us and let us know how we can be of assistance to you. So thank you guys so much. Let's make home buying a less stressful experience for everyone, and we will see you in our next video.